Well, here in Spain, it's Brett Hanson's turn to join us again in the studio, and he'll be here next week as well. Brett, how are you doing?
I'm doing good, thanks. I'm looking forward to the end of summer.
Yes, to that, I think we can agree on that, I'm sure.
Not long away now.
No. Following the autumn 2024 budget, a consolidation was initiated, and I understand it is now concluded. Can you tell us what the outcome is?
Yes, certainly, Howard. So our listeners may recall that in last autumn's UK budget, the Chancellor, Rachel Reeves, made some big announcements on changes to UK inheritance tax. Probably the one which got most of the headlines, especially with the protests from farmers which led on from the announcement, was the reduction in the UK inheritance tax relief on qualifying agricultural and business property. So under current rules, Howard, qualifying agricultural and business property benefits from 100% relief against UK inheritance tax. This means, for example, that farmers can leave their farms to their children free of UK inheritance tax. But the Chancellor announced changes to this in last autumn's budget, and a consultation was initiated into the operation of this. This consultation has now been finalised and very recently confirmed that the changes announced will proceed, which means that as from the 6th of April of next year, the 100% relief will apply to the first £1 million of qualifying agricultural and business property, but above the £1 million threshold, the relief will be reduced to 50%, i.e. there will be an inheritance tax rate of 20% applied on these inherited assets above £1 million.
Did that inheritance tax consultation also extend to UK pensions?
Yes, Howard, it did. So another significant change announced in the budget last autumn also relates to UK inheritance tax, and this is that UK pension funds will start being liable to UK inheritance tax as from the 6th of April 2027. Again, a consultation was announced, but on this matter, the consultation was narrow in scope in that it was restricted to purely the administrative operation of this proposal. And the results of this consultation between HMRC and the pensions industry were twofold. Firstly, that there will be no change to the announcement in that UK inheritance tax will apply to pension funds from the 6th of April 2027. And secondly, that when it comes to the paying of UK inheritance tax, the estate's personal representatives will be responsible for the administration of both the estate and the pension scheme. I guess there was one piece of good news which came out of the review, Howard, which was that there was a confirmation that death in service benefits paid by UK registered pension schemes will be excluded from this change. So death in service benefits will remain exempt from UK inheritance tax. But the really important thing for listeners to bear in mind is that if you die after the 6th of April 2027 and leave your UK pension fund to, say, your children, then this will potentially be liable to UK inheritance tax. And if on the death of you are over the age of 75, then not only will your estate pay UK inheritance tax at 40% on your pension funds over and above the IHT allowance, but when your children draw down on the pension, then those drawdowns will be treated as income and subject to income tax at their highest marginal income tax rate. So in effect, your pension fund could be taxed as much as 85% before reaching your children's pockets.
Well, will these changes generate a substantial amount of additional revenue for the UK government?
This is a good question, Howard. With regards to the agricultural and business property relief, in the 2020 to 2021 UK tax year, just under 6,000 estates claimed either agricultural or business property relief. And as a result of this meant the UK Treasury lost around £1.7 billion in potential UK inheritance tax. The UK government has said that most estates claiming the relief will not be affected by these changes because they are intended to target the wealthy minority, estimating that only around 2,000 estates will actually pay more tax. But Howard, there's no doubt that there has been a big increase in the amount that HMRC receives from UK inheritance tax over recent years. During the second quarter of this year, just the period between April and the end of June, the UK government generated around £2 billion from inheritance tax receipts. That's actually £134 million more than for the same period last year. And it means that inheritance tax revenues for the financial year is running at about 6% ahead of the same period last year, which was already a record year. In March, the forecast from the Office for Budget Responsibility predicted that UK inheritance tax will generate over £9 billion in taxes this year, but that by the end of 2030, so just over 5 years from now, those revenues are projected to rise to more than £14 billion every year. I guess this isn't surprising, Howard, when you consider how consecutive governments have continued to extend the freeze on the inheritance tax threshold of £325,000, which has now been frozen since 2009 and will stay in place until at least 2030. And over this time, property and asset prices, as has inflation, have all increased. And then added to this are the changes I've just mentioned, where Rachel Reeves has, over the coming year or two, increased the scope in which this tax will be calculated on.
What should we be aware of, and what steps do you recommend?
Well, Howard, there's no doubt that for the reasons we've discussed today, UK inheritance tax is going to continue to impact more and more people. And I think it's quite clear that regardless of who's in government, whether they are right or left-leaning, taxes are likely to increase in the coming years. And while Spain is also seen as a country with quite high taxes, there are ways to legitimately minimise taxes here, whilst at the same time avoid UK inheritance tax being paid in the future, particularly with the recent changes to the rules on domicile. So if you're listening to this broadcast whilst you're on holiday here in Spain, or you are listening to us from the UK and are thinking of moving to Spain, then you may want to contact Blevins Franks. We can analyse your tax liabilities for both Spain and the UK in order to see whether you would be better off living here in Spain rather than living and paying your taxes in the UK. And at the same time, we can outline what steps should be taken both before and after the move in order to put yourself in the best position with regards to both tax and peace of mind.
Thank you, Brett. That sounds to me like we need to revisit the infamous strategic financial planning. Can we do that next week, Brett?
Yeah, absolutely. Look forward to it.
And of course, new listeners or old listeners can always get the updated information at the website, blevinsranks.com.